Hello, everyone. My name is Nathan Corey from Richardson Capital Management. Alongside me is Dan Brown, our Director of Investment Management, and we're here today with the Economic and Investment Update for the first quarter of 2025. Dan, after a strong start to the year, we had stocks peaking maybe around mid-February after a strong month and a half. And then we saw quite a bit more volatility with concerns around things like tariff policy and maybe, the direction of the Fed going forward. Do you want to give us just a quick recap on what we saw performance-wise for the quarter?
Yeah, so as you mentioned, Nathan, strong start to the quarter. Again, stocks made all-time highs in mid-February, and then right around then, the tariff talk from the new administration started picking up pretty strongly, and it was kind of a on again, off again tariff talk,
Hmm.
kind of for the last 6 weeks of the quarter. We're supposed to hear some more clarity on April 2nd around tariff announcements. We think there'll be more broad announcements for applied, kind of unilaterally across many countries,
Right.
many of our largest trading partners. So that dragged down stocks the last 6 weeks of the quarter here. But not off terribly. I think the S&P is going to end the quarter down around 3%,
Hmm.
not terrible. And then within fixed income, we actually saw fixed income provide a traditional role that we've seen in the past where stocks sell off, experience some volatility, and fixed income holds up very well. So actually performed very well in a diversified portfolio, being up for the quarter as interest rates declined, a little bit over the course of the quarter.
Right.
And the last thing we'll add on stocks is the fact that small cap stocks got hit a little bit more in the quarter, but international stocks actually held up fairly well.
Hmm.
So for the most part, they've kind of sidestepped most of this negative tariff news.
And Dan, when we're talking about stock market performance, particularly here in the US, most investors are probably familiar with the S&P 500 as being a main index that folks look at. But an important nuance that some investors might not be familiar with is the fact that that index is market cap weighted, meaning that the largest companies in that index take up an outsized portion of the performance of the index. Do you want to maybe provide a little bit of info on kind of what that led to over the past couple of years and so far this year?
Yeah, so that's a very important dynamic that we should discuss. So as you mentioned, S&P 500 is market cap weighted, not equally weighted or price weighted. And what's happened the past couple of years is those largest stocks from the index, the top 10, for example, now comprise the largest weight that they
Hmm.
ever have comprised. I think a lot of people are familiar with that concept or of the name of the Magnificent Seven.
Hmm.
So those Mag 7 stocks have really done very well, performed very well the past couple of years, especially in the post-COVID era, and they've comprised a very large percentage. So the index has done very well the past couple of years in 2023 and
Hmm.
2024, mainly because those largest names did so well. So they kind of pulled the index higher
Right.
as they outperformed, and we're seeing kind of the reverse, the opposite of that. And that dynamic means that with those Magnificent Seven names underperforming, they're dragging the overall index lower. But what's really interesting is if you just look at the 500 stocks from the S&P 500 and you equally weight them, we ended the quarter essentially flat for
Hmm.
those 500 stocks. So not terribly concerned about what's happening within the overall index.
Right.
We just need to be aware of why the index is underperforming. And again, a lot of it is just due to those fact that the largest names in the index are underperforming after performing extremely well the past 2 years.
Right. And Dan, with the increase in market volatility we've seen since mid-February, a key word hitting the financial press has been the idea of a correction and entering correction territory. A correction, obviously, being a technical term which applies to any time there's a drop in stock price value of more than 10% from peak to trough. Do you want to talk a little bit about how rare that type of an instance is and what, if anything, we can glean about that on performance for the year?
Sure. Actually, it's not that rare. In fact, it's fairly common.
Hmm.
So the graph that we're showing here just looks at annual returns going back to 1980. And what we're showing here is, with the blue bars is the annual price return for the S&P 500. And with the red dot that we're showing here, we're just showing the peak to trough decline throughout the year. So the intra-year decline. So for example, for 2024, we show that the S&P was up 23% on a price return basis, and it had a peak to trough decline of about 8%. And what we're showing in the title is that the average intra-year decline is about 14%. So again, it's not that uncommon to have a drawdown or a correction during the year. So as you mentioned, we just experienced a 10% correction in the
Mhm.
S&P 500. Again, only down 10%. It could go down a little bit further from here, but again, we're not terribly concerned about it at this point in time. But the main message is just the fact, look at the number of blue bars here, positive blue bars. So the S&P basically finishes up in a positive territory about 75% of the time. Those are pretty good odds in our mind that you should, stay invested in the market. So don't try and time the market per se. Just, continue to be invested in the market and let that wealth try and compound over time.
And Dan, with that backdrop in mind, I think it's safe to say that our kind of cautiously optimistic approach and our disciplined strategy remains intact so far for the year. But what do you see kind of coming into the rest of the year as far as our strategy?
Yeah, so not much has changed on our outlook compared to the previous months, previous quarters. We still expect, financial markets to be positive this year, backed by the fact that we expect the Fed to cut interest rates a little bit further in the second half of the year, maybe 2 to 3 cuts. I think we noticed as of late last week, a third rate cut was the highest probability.
Mhm.
We think, two for sure. And we think that earnings growth, I mean, that's going to be the main catalyst to drive stocks higher in the year is the fact that earnings growth should be decent and could be double digits, and that should set up for a pretty positive stock market. And as far as, investing within the stock market, we still like US stocks over
Mhm.
international stocks. We mentioned last month that we sold one of our international positions and shifted those proceeds into US stocks.
Mhm.
So we think the recent run of international stocks over US stocks will end fairly soon, and it could end with the tariffs coming into effect in April. And if the tariff news does hit economic growth pretty severely, again, we think the Fed will be pretty responsive, and we wouldn't be surprised if the administration kind of pulls back on their tariff announcements.
Well, with that, we want to thank you for watching. As always, we appreciate your continued trust and support. And of course, feel free to share this video with others if you think they might find value in it.